real estate depreciation from someone who knows nothing about it? How would you explain it to, I don't know, someone new that walked into your firm and said, hey, I own property. I heard I could save taxes. Then what's this depreciation thing people talk about?
So depreciation, what it is basically is the principal amount or basically the overall cost that you had spent to acquire the property wrapped up into one. And what you're doing is recognizing the incremental use or the wear and tear of that property over a specific time. So when it comes to real estate, and depending on how the real estate is managed, if it's a residential property, you can depreciate your real estate over 27.5 years, 27 and a half years. And so, for example, let's say you're buying a house for $300,000 or whatever, rather than being able to take $300,000 as a deduction in the same year, which would be incorrect because you're going to be able to use that house for a long period of time. You just recognize $300,000 divided by the 27.5 as an incremental expense amount on your tax return for that particular year. And so that expense is now a line item that you can use with offsetting your rental income, along with various others. But real estate, just focusing on that particular question in particular, it's the principal cost amount that you have basically spent to acquire the property that is recognized over a long period of time, because that is the period of time that asset is supposed to be benefiting you in your business.
Thank you for that, Paul. And what is this, I'm not going to say new thing because it's been around forever, but it's just something that I guess now it's a lot easier to take advantage of. What is bonus depreciation?
All right, so special bonus depreciation, what that is, it's one of several provisions that are available for taxpayers to actually take or accelerate the amount of depreciation certain assets, certain tangible or intangible assets have in the same tax year. For example, if you have a house and you did a repair that was classified as improving or extending the useful life of that particular of your house, for example, rather than taking that expense amount over a long stretch of time, you can accelerate it and recognize it in the same tax year. If the overall cost was $30,000 that you would recognize over the useful life of the house, you can take that $30,000 expense line item on your tax return for that particular year, which would generate a huge amount of expenses that can be offset against your rental income, therefore creating a loss. And depending on how your real estate venture is categorized, those losses will either be suspended to offset future gains or future profits, or if you're going to sell your house, those losses will now offset the overall gain that you would have earned on the house. Or those losses can now be used to offset your ordinary income, creating huge tax savings for yourself.
Man, this is such a benefit, guys. I can't say enough how more people should be at least aware of this. Everyone doesn't want to get rich. I get it. Everyone doesn't want to save tens of thousands of dollars on their tax liability. But from a W-2 standpoint, right? You talked a little bit about active income versus passive income at the beginning of the call. Scenario, right? I'm a sales guy. I made $80K, but commission I made $120. My W-2 says I made $200,000 this year. That's not from real estate, that's from active income. And let's say my spouse can be classified as a real estate professional. He or she's a realtor, they do a lot of real estate activity, and they meet the criteria. What is the benefit of that? They have that real estate professional status.
Just so that people understand what real estate professional status actually it actually means. You don't necessarily have to have a real estate license. You just have to be able to prove that a significant amount of your time is spent on managing your real estate activity. Okay, so if you're able to do that, so for your spouse, because this is a beautiful scenario, So if your spouse is not working at all and you have several houses that you're managing, you earning the $200,000 or whatever the case is, and you guys are filing jointly, the losses that are sustained from the real estate professional activity is going to be offsetting your active income, the active $200,000 income. So if you paid Uncle Sam the $60,000 or whatever in taxes, unfortunately, it'll just be box two. You can get most of that back because of the losses that are sustained from the real estate professional status activity that your wife is doing. And that's a beautiful scenario for a lot of people. So if you have a spouse that is not working and you have houses that you are maintaining, the real estate professional status, we can actually use her as the front run liner for that.
I'm going to keep it real simple. You're saying that if, let's say my wife and I'm a real estate professional, she has a W-2 job, let's say she makes $200K, and let's say I make $100K on my real estate activities. What you're saying is that if we own real estate and we bought it in the same year, I could use bonus depreciation from my real estate to offset that income.
Yeah, so just to kind of define that a little bit better. So on your 1040, your tax return, there's a section where you're claiming gross income, however derived. The very first line is W-2 income. And then towards the bottom, like line 10, is income earned from your business, or in this case, the real estate activity. If my W-2, you're 1000% correct. It was reported to the IRS. They know for sure I made $200,000. However, on my business side, even though I made $100,000 profit, I am subject to actually taking advantage of Internal Revenue Code section 162. Anything that's ordinary and necessary for my business, my trader business, I can go ahead and write off. So based off of all of my deductions, maintaining the house, driving to the house, having to go look for tenants, having to pay utilities, the bonus depreciation, all of that will now will go ahead and offset the $100,000 that you've earned from the real estate activity. If the end number is, let's just keep it simple. Let's just say the end number is $50,000 in losses. That $50,000 loss now goes on line 10 of my gross income calculation for my taxes. Guess what? $200,000 minus $50,000 is $150,000. So you're not paying taxes on $200,000 anymore. You're paying taxes on $150,000. So what it looks like now, based off of your current withholding that you have on your taxes, you overpaid your taxes. So therefore, you're getting a higher refund back because you paid too much to Uncle Sam. We have a real estate activity. We sustain losses. Those losses are meant to actually offset that income. So now, instead of paying $60,000 in total expenses to the IRS, you're getting back maybe, let's just say 15. I don't know, just guessing. Let's just say it's $15,000. That $15,000 goes a long way. I can take that with paying for an improvement on my property, or investing it in something else, or basically building generational wealth. This is how it all connects.
I could put that money down in another house.
Yes.
Use that money to put down. Yeah.
Investing in your generational wealth. Yes. Buying another house or whatever.
And Paul, just for the families who have kids, do I still get my tax credits for my children and everything, including this?
Yeah, so because you've earned $200,000, you are well above the threshold with actually receiving certain credits. Or some of your credits are actually phasing out, like the child care credit, and for some people, the earned income credit, or the child dependency credit, whatever, right? $200,000 would have put me out of that threshold. Because of that $50,000 loss, I get put back into that threshold. So therefore, my credits are extended. And then we could talk about this later, I know, but you do have a business that you're managing over here. And if your kids are able to walk and at least talk, you can actually pay your kids, creating additional losses. And so, for example, let's say you have a kid, as long as their salary is under the standard deduction of $15,000, they do not have to file a tax return, because $15,000 minus the freebie of $15,000 is zero. Zero, you can't necessarily tax anything on that. So therefore, you just created losses for yourself that you can now use to further offset your W-2 income and bring yourself to more tax savings. So kids are actually really good for you.
So they take your money, but they also save you money too.
Yeah, exactly. This is
Okay.
kind of how you align yourself with your business. So if you're actually paying your kid, you can actually have your kid pay for the things that they need. But sorry, going too far.
What you just pointed out from a numerical standpoint, so I just pulled it up. The average salary or yearly wage in America is around $40,000. I think it's like 39,000 something. So if someone has enough real estate, they could literally get a salary back in a tax refund, is what you're saying. I just want to be clear.
Yeah, it's definitely possible. If paying your salary to you is considered a necessary expense for your business, in most cases it is, then yes. So for example, let's say your child is able to drive and they need to run to the store to go get an air filter. You need to compensate him for his time, right? And I need that air filter to keep my house, the air quality in my house clean. So therefore, yeah, it's an ordinary and necessary expense. Section 162, I'm writing it off. I'm creating a loss. And then therefore, that special bonus depreciation, again, it doesn't necessarily matter how exactly you pay for it. Most of the time, they're financed. You can finance it at the end of the year and put $1 towards it. It doesn't matter. As long as that charge has been paid in full in that tax year, we're accelerating it. You have the option of accelerating it. And so therefore, it's not like as if you're creating losses on losses because you lost all these dollars. But no, you're actually creating losses based off of the fact that you're just accelerating a depreciation of an asset.
So, in other words, using leverage and financing to acquire real estate and actually using some of the note that you haven't paid off yet to be used in the depreciation formula is what you're saying. So, and I'll break it down as an example. If I bought a home for $400,000, I put $100,000 down. But let's say when you do my accelerated depreciation thing, and I qualify for bonus depreciation, let's say that house gets me a $200,000 year one loss. I could use that amount as a deduction.
Yes. So the $400,000 that is the actual sales price or the cost basis of your home. That's what you are putting through the regular depreciation. Remember what I said, the principal amount of the house, you can't accelerate that. So, but if you actually go through and like you said, and go through and actually do a cost segregation analysis and see, okay, by itemizing all of these things out, figured out that $200,000 that was paid towards this house was actually these items. And so I want to, accelerate these items. Yeah. So despite the fact that you haven't paid this whole thing off, it doesn't matter how you do it. You can put $1 down, $100,000 down, whatever the case is. $200,000 is the asset that's considered the improvement that's supposed to be benefiting me for, several years. Typically, an improvement like this is depreciated over 39 years. But yeah, you can take a $200,000 line item as a deduction in that year if you see it as a benefit for you. Yes.
That was for my salespeople because my wife is in sales and, she works with a lot of salespeople and they don't know how powerful real estate is when it comes to these things when they are married, when they have a spouse, or if they own a short-term rental and actively participate, which is our next segue into our next thing.